If you took out a reverse mortgage more than a few years ago, stop scrolling for the next 10 minutes because your interest rate may have been quietly rebuilt on a completely different formula and almost nobody called to tell you. Every adjustable rate reverse mortgage in this country runs on an index. For decades, that index was LIBOR. In 2023, the federal government forced every lender and servicer holding a LIBOR-based reverse mortgage to switch that loan onto a new index, on a deadline, whether the homeowner understood what was happening or not. Some servicers did the math correctly, some did not. And the only way you find out which one happened to you is by checking the paperwork yourself. Today I'm going to walk you through exactly how your reverse mortgage rate is built, what changed in 2023, how to check whether your loan was converted correctly, and who to call if it wasn't. Stick around for the last section. It covers the one document almost no reverse mortgage holder has ever asked their servicer for, and it's the document that actually proves whether you're being charged fairly. Subscribe before you go anywhere else. Reverse mortgage servicing rules shift constantly, and when they shift, the burden of noticing falls on you, not on the bank holding your loan. That's the gap this channel exists to close. A retired school teacher in Reno, I'll call her Marilyn since she asked me not to use her real name, took out a reverse mortgage in 2011. Adjustable rate, tied to LIBOR, standard for that era. She never thought about the index again. Why would she? The statements came, the balance grew the way she'd been told it would, and she went about her retirement. 3 years ago, her son-in-law, a mortgage broker, glanced at one of her annual statements out of professional habit. He noticed the index listed didn't match what her servicer should have been using after the 2023 transition. One phone call and a request for her adjustment history later, the servicer admitted the loan had continued accruing under an outdated calculation for several billing cycles before the correction was applied. Marilyn's case isn't a horror story. It's a paperwork story. And paperwork stories are exactly the kind that go unnoticed for years, because nobody expects a bank to make an error in its own favor and just leave it there. Let's build the foundation, because you need to understand this before anything else makes sense. A reverse mortgage, technically a home equity conversion mortgage, or HECM, when it's insured by the FHA, doesn't charge a flat interest rate the way most people assume. On the adjustable rate version, which is the majority of HECMs originated over the last 15 years, your rate is built from two pieces: an index, which moves with the broader financial markets, and a margin, which is fixed by your lender at closing and never changes for the life of the loan. Add the two together, apply whatever adjustment schedule your loan uses, monthly or annually, and that sum is your interest rate for that period. Here's where it gets specific to anyone who closed AHECM before the middle of 2023. For years, the index almost every lender used was LIBOR, the London Interbank Offered Rate. LIBOR was the global standard for adjustable financial products for decades. Then it was discontinued. Regulators around the world spent years planning for that shutdown, and in the United States, HUD published Mortgagee Letter 2021-08 to start the transition, first barring LIBOR on new HECM originations and steering the industry toward a replacement called SOFR, the Secured Overnight Financing Rate. That was step one, and it only affected new loans. Step two is the part that touches you if you already had a loan. In March of 2023, HUD finalized a rule requiring every existing LIBOR-based HECM adjustable rate to convert to a spread-adjusted SOFR index, and it set a hard deadline. The conversion had to happen by the next scheduled interest rate adjustment date on or after June 30th, 2023. 2 months later, HUD specified exactly which SOFR index servicers were required to use, the CME Term SOFR Index, chosen specifically because it was supposed to track closely enough to LIBOR that borrowers wouldn't see a jarring change in their rate. On paper, this was designed to be a quiet, neutral swap. In practice, it required thousands of servicers to correctly reprogram millions of individual loan files, each with its own margin, its own adjustment date, and its own history. Any system-wide conversion at that scale creates errors, not because anyone intended to shortchange homeowners, but because manual and semi-automated processes touching that many accounts always produce a percentage of mistakes. Think about what that means for your specific loan. If your servicer failed to convert your index on time, you may have spent months or longer accruing interest under the wrong benchmark. If they applied the wrong spread adjustment when making the swap, remember the whole point of the spread adjustment was to keep your rate roughly where it would have been under LIBOR. An error there means your rate has been running higher than it should for every day since the conversion happened. And if your loan had a monthly adjustable rate rather than an annual one, the required index was different again, which means there were more places for a servicer to apply the wrong instruction to the wrong loan type. Let's put a number on this so it isn't abstract. Say your reverse mortgage carries a fixed margin of 2.5%. Your loan balance sits around $180,000, and a conversion error left your effective rate running half a percentage point higher than it should have for 18 months. Half a point on $180,000 works out to roughly $900 a year in extra accrued interest, money that compounds against your balance for as long as the loan is outstanding, and money that reduces the equity available to your heirs when the home is eventually sold or the loan is settled. That's an illustration, not a guarantee of what happened to you. Your actual exposure depends entirely on your margin, your balance, and how long any error ran. But it shows why a half-point mistake is not a rounding error over the life of a loan that can run for decades. I want to pause here and say something plainly. If you've had a reverse mortgage for years and never once checked the index or the margin, that is not a failure on your part. Almost nobody reads their annual adjustable rate mortgage statement line by line, and reverse mortgage paperwork is written in language that seems designed to be skimmed rather than understood. The responsibility for getting the 2023 conversion right sat with your servicer, not with you. What sits with you now is simply the choice to check. So here's what I want you to actually do, and this is the part worth writing down. Start by requesting your loan's adjustment history directly from your servicer. Every HECM servicer is required to be able to produce a record showing your index, your margin, your adjustment dates, and your rate history since origination. Call the servicing number on your most recent statement and ask specifically for the interest rate adjustment history since 2022. Don't accept a verbal summary. Ask them to mail or email you the actual document. Once you have it, look for three things. First, confirm which index is listed for periods after June 30th, 2023. It should show the CME Term SOFR index, not LIBOR. If LIBOR is still appearing as the basis for any adjustment after that date, that is a documented error, full stop. Second, check that your margin, the fixed number added to the index, matches the margin disclosed in your original loan documents. That number should never have changed. Third, look at the dates your rate actually adjusted. Annual HECMs adjust once a year on your loan's anniversary. Monthly HECMs adjust every month. A missed or delayed adjustment date is another sign something in the conversion process broke. If anything looks wrong, your next call goes to a HUD-approved housing counseling agency, not directly back to your servicer. HUD maintains a free counseling line specifically for homeowners with HECM questions and disputes, 1-800-569-4287. These counselors are independent of the lenders and servicers. They deal with reverse mortgage conversion issues specifically, and they can help you determine whether what you're seeing is a genuine servicing error or a normal part of how the index moved. If the counselor agrees something looks off, they can help you file a formal dispute with your servicer, and if that doesn't resolve it, escalate a complaint to the Consumer Financial Protection Bureau, which tracks reverse mortgage servicing complaints specifically. Here's why the timing matters more than it might seem. The longer an incorrect rate runs uncorrected, the more interest compounds against your home's equity, and the harder it becomes to reconstruct exactly when the error started once years have passed and paperwork gets harder to track down. If Marilyn's son-in-law hadn't looked at that statement when he did, the outdated calculation would have kept running quietly, month after month, for as long as nobody asked the question. I also want to address something that comes up every time reverse mortgages get discussed, which is the fear that questioning your servicer puts your loan at risk. It doesn't. A HECM is a federally insured loan. Requesting your adjustment history, asking your servicer to verify the index they're using, or contacting a HUD counselor does not affect your eligibility, your line of credit, or your right to remain in your home. You are not accusing anyone of wrongdoing by asking a question. You are doing exactly what HUD's own conversion rule assumed borrowers would eventually do: check the file. If you were born before 1958, there's a reasonable chance your reverse mortgage originated well before the 2023 transition, which means your loan sat directly in the path of that conversion. Your rate should currently be built on the CME Term SOFR index. If your loan adjusts annually, your margin should be unchanged from the day you closed, and your adjustment dates should be running on schedule. Those are the three things to verify, and they are the three things almost nobody has actually checked. Before you close this video, find your most recent reverse mortgage statement and call the number on it. Ask for your interest rate adjustment history since 2022. If the index isn't SOFR based for any period after June 2023, or if the numbers don't match what you were told at closing, call the HUD counseling line at 1-800-569-4287 and tell them what you found. Send this to anyone you know who's had a reverse mortgage since before 2023. A parent, a neighbor, someone from your church. It takes them 10 minutes to make one phone call, and if their loan was converted incorrectly, that call is the only thing that stops the error from compounding for another year. That's what this channel is here for. I'll see you in the next one.